Hey everyone, this is Robert Keens with goldsilverpros.com. It is Tuesday, March 16th, 2021. And for today's video, we're going to be looking at gold and whether or not it is a tier 1 asset when considered on banks' balance sheets. Over the last 24 hours, I've received more emails and phone calls over this than probably anything in 2021. And there seems to be a big internet debate raging on Twitter and on YouTube with regard to how gold is going to be treated for bank reserves. And I think a video done by one gold observer, gold analyst, perhaps maybe didn't do a deep enough treatment there and was pointing the finger at another gold analyst. Since then, I believe this gold analyst has said they're going to amend their position on this, basically because I asked them to off of Twitter, so I appreciate that. But I think because this is such a complicated topic, and people who don't have a lot of experience in this area or haven't had the time simply to sit down and read all of the changing and morphing regulations from the BIS, it's worthwhile for me to do a video on this. So that's what I'm going to do. I'm going to give you a presentation today on the Basel requirements and how gold is affected in those requirements across different measures and ratios that they have. And we're going to talk about, is gold truly a tier 1 asset, or is it considered something that the banks would want to hold for their stability, for their funding stability? Let's go ahead and get right into the presentation. We're going to start off with a PowerPoint that I have here for you. Actually, we're going to start off with the video. So the original video is entitled, "The BIS confirms gold is not a tier 1 asset." As you can see down here, it was done by Mario, who goes by Mineko64. And he basically went on to say that gold as a tier 1 asset was something, was a concept that was promulgated by Andrew Maguire. He was the sole source, according to Mario, of that rumor, and that it's not supported by the BIS. And this video, I thought, was a fairly light treatment of the subject matter, and I'll get into that here in a moment. But I wanted to show you a screenshot of what Mario had in his video. This is the return email from the BIS with regards to whether gold is a tier 1 asset. And this is the proof that Mr. Ineko used to basically say that Andrew Maguire had it wrong. And essentially they go on to say that tier 1 and tier 2 has to do with regulatory capital, has nothing to do with assets, and no, gold is not a tier 1 asset. And this is what lit the internet on fire. Oh no, gold's not a tier 1 asset. What does that mean for gold going forward? Let's slow it down a moment and see what gold's new role is going to be in the new regulatory system under Basel III, and whether or not the term tier 1 makes any difference. I'm going to contend that it doesn't really, and it's more a descriptive term than anything. And this email from the BIS does nothing really to dissuade me from the thought that gold is going to play a more prominent role in the banking system than ultimately Andrew Maguire's right, even if his terms are wrong. But to be fair, I wanted to show you my response over Twitter to this video. This is Mario's video that was quoted by another user. And this other user is saying gold will not become a tier 1 asset. And I had a response to that here in the comments, but Mario shows that he did a little bit more research, and gold can be subject to domestic regulators as 0% credit risk weighted asset. So he went on to amend it here on Twitter. This is my response. Why didn't you explain this in your video? I'm pretty upset with the way you betrayed Andrew in your response. There is no tier 1 or 2 asset class. Those terms refer to regulatory capital. But his point stands about the role of gold in regulations, and I'm going to show you that in the presentation. I went on to say further that gold is more important to determining asset quality and can be equal to cash per BIS regulations. You didn't explain this. You gaslighted the entire gold community and created mass confusion, to which he responded, "I will be clarifying what I learned, and I think it is all to do with mixing terms like capital and assets. It was not my intention to confuse people." So I don't think Mario intended to confuse people, but I don't think he read far enough along in the Basel regulations to understand the difference between capital and asset and what all of this means. And so at the end of the day, I am happy with the response, however, because I think he's going to go back. He may have already done it by the time my video is published and posted a clarification as to what he meant there. So we're going to go back to the PowerPoint presentation. I'm going to get into how gold is going to be treated by Basel. I have talked about this to some extent in my other Basel videos. I did 4 within the last year on Basel specifically. But it was mostly around net stable funding ratio, which is one of the ratios we're going to talk about today. But we're going to back it all the way back up, and we're going to talk about gold and the role of the international banking system. So the title of the presentation is Capital Ratio, a discussion of BIS capital requirements and asset quality. Presentation by myself of Gold Silver Pros, March 16, 2021. First question is, who makes the rules on capital and assets? This is a quote from a reference I'm going to give you. It's right here, but I'm going to give you all the references at the end of this presentation. So you can pause the video at the other end of the presentation, find my references, and go look at them for yourself. The quote here is, the Basel Committee on Banking Supervision, known as the BCBS, is the primary global standard setter for the prudential regulation of banks and provides a forum for regular cooperation on banking supervisory matters. Its 45 members comprise central banks and bank supervisors from 28 jurisdictions. So that's basically who's making the rules here. So what is the capital ratio and what is tier 1, tier 2? Well, let's get into that. Tier 1, tier 2, and tier 3 regulatory capital to be divided by banking assets. So in other words, you have capital and you have assets. They're different. Now, when you look at the documentation from the BIS, this is very confusing because when they go on to talk about tier 1, tier 2, and tier 3 and regulatory capital, they don't make a distinction between those tiers in capital and the tiers and assets, at least not by naming convention. They do have some charts, which I'm going to show you further in the presentation, but they don't name the assets, tier 1, tier 2, or tier 3. And they don't separate it out in their discussion of capital and assets, which makes it very confusing. So let's define some terms here. This is a simple ratio that is designed to describe the credit quality of banks. The tier 1, 2, and 3 designations refer to equity and disclosed reserves. Disclosed reserves, further defined as retained earnings, and are put into the tier 1 category. So equity and retained earnings are tier 1. Non-disclosed reserves are referred to as supplementary capital, also known as tier 2. And a third tier was defined later on in a refined treatment of the topic from 2013. However, not important to this particular discussion about gold asset quality. So you've actually got 3 tiers of regulatory capital. That's the top half of the equation, which I'll show you here in a moment. And it refers to equity and disclosed and non-disclosed reserves. Generally, assets can be about 50% from tier 1 and the rest from tier 2 or tier 3 per the regulations. That should clear up what tier 1, tier 2, and tier 3 referred to as equity, disclosed reserves, and non-disclosed reserves, not all of the other assets. Here's the official capital ratio. On top, we have the regulatory reserves, which I just got through talking about, tier 1, 2, and 3. And on the bottom, you have the risk-weighted assets. And it says here, quote from a paper that will be in the references at the end of this presentation. Accordingly, the committee confirms that the target standard ratio of capital to risk-weighted assets, so we have capital on top, risk-weighted assets on bottom, that's where you get your ratio, should be set at 8%, or a minimum of 8% is what they're saying there, of which core capital element will be at least 4%, meaning the core capital is tier 1. Tier 1 is at 50%, remember, from up here. That's the highest quality tier. That's also in the paper called core. So tier 1 and core is basically the same thing. That should be 4%. So all of those should add up. At least 8% shareholders' equity, disclosed and non-disclosed reserves. That should be the ratio to risk-weighted assets, I'm sorry. And tier 1 is 50% or 4% of the 8%. Okay, so that should clear up what the capital ratio is. Now let's get further into gold. So the questions we have, is gold a tier 1 asset, as Andrew McGuire has said, and I've actually said before in the past as well. If not, why? What is gold and why is it important? We'll get into that. And does Basel tell us how banks can use gold in asset calculations? Yes, they do, and we'll get into that as well. So in 2013, originally back in 1988, we had the original sort of Basel requirements for this, and then it was amended after the financial crisis in a paper published in 2013, and that's what we're going to talk about now. Now, 2 new ratios were introduced in 2013, the liquidity coverage ratio, the LCR, and the net stable funding ratio, the NSFR. We'll get into those in a moment and how they differ and what they're for. We'll address gold's role with respect to both of those measures, and we'll answer the question of whether gold is considered equivalent to other high-quality assets, regardless of what terms we want to use. Because again, I'm contending that in the BIS papers, in terms of the assets, the bottom half of this equation, they do a poor job of labeling those. The capital, the equity, and the retained earnings and non-disclosed earnings or capital, they do a good job of defining those. But when it comes to the denominator of this question, the risk-weighted assets, they don't do a good job of explaining the tiers. And I think that's where we get confusion about what to call these things. I think the paper was just a little bit lazy in doing that. Okay, now talking first about the net stable funding ratio. This is something I've talked about again in 4 previous videos. We're going to get into the basics of it. The document presents the net stable funding ratio, one of the Basel Committee's key reforms to promote a more resilient banking sector. The NSFR will require banks to maintain a stable funding profile in relation to the composition of their assets and off-balance sheet activities. This is a quote from one of the BIS papers. So you take the, on the top of the net stable funding ratio, you have the available amount of stable funding over the required amount. Available means you can get to it, it's liquid. And we'll see liquidity further on down and how they use liquidity. So net stable funding ratio is just a ratio of the available amount of the stable funding to the required amount of stable funding. What is that stable funding? It's the assets, okay? So that's how NSFR relates to the capital ratio. So we're starting to make some connections here between these different terms from the BIS. The available stable funding is essentially this. Available amount of stable funding is the top part of that ratio. How much of your stable funding that you're saying that you have for your assets is actually available, liquid, ability to get to it? Well, what the BIS did was they took common assets and they gave it a factor. If you had a factor of 100%, it means they're going to weight your available funding at 100%. If it's 95%, they're going to take a 5% discount. 90%, 10%, 50%, 50%, and 0%, they're not considering it to be available or liquid. So they have a chart here about available stable funding. You'll notice in this chart, gold does not appear. Where does gold fall? We're going to talk about that because we have to dig further down into that documentation. And again, this is where the BIS is really confusing when it comes to gold, because you really have to dig around to find gold in here, but gold is in here. So we're going to go to another table. The ASF for gold specifically is assigned an 85% factor. So if we go back up here, it's 85%, which is not on this ASF chart. But if you read further in the documentation, it gives it 85%. And that includes, it's treated as a commodity here. So like any physically traded commodity, it's liquid, but it gets a discount of 15%. Why does it get a discount of 15%? Because there's basically price risk. There's price risk that commodity price will go up and down, and that's treated elsewhere in the paper. We're not going to get into that. Anyway, for now, we're going to say that gold is treated as 85% from a available stable funding for net stable funding ratio. This is just net stable funding ratio. We're not talking about whether it's a tier 1 or tier 2 asset, but I wanted to make this distinction here that they're trading gold at a 15% discount. Or are they? We're going to see here in a moment where not really. There's 2 types of gold, allocated and unallocated. This ASF for gold, the 85%, is for unallocated. And we'll see how they're going to treat allocated gold later on. So the asset risk haircut table, it gets even more confusing because it has gold now at a 20% rating, whereas cash is 0, meaning cash has no risk, therefore it gets no haircut. Gold gets 20%. So did we just say 15% here? We said 20% here. Yeah, because the BIS is very confusing. And this is coming in a progression of documents since 2013. The thing about the BIS is they keep revaluing gold as a funding mechanism for banks from 2013 all the way through to the present day. So I'm basically showing you different opinions through time, and we're going to get to where gold is treated as now. So don't let these various tables and definitions I'm showing you now confuse you as to the end value of gold. This is just the progression from 2013 to now. I wanted to bring you through that progression so you can see how gold has been valued higher and higher over time. And there are reasons for that. There's research behind that, which I'm going to show you later in the presentation. All right. But wait, in 2017, the BIS seems to have changed its mind on gold based upon the research presented. There was independent research papers that said, wait, you're not giving gold appropriate recognition in terms of risk, and it should be considered more strongly. And finally, Basel released in a paper called Basel III, Finalizing Post-Crisis Reforms. They decide to consider gold no risk when it's held in allocated form. So this 15% back here is for unallocated gold. We'll get into the distinction between unallocated and allocated here in a moment. But as of 27, the BIS considers gold to be no risk where it's held in allocated form. The direct quote is, a 0% risk weight will apply to cash owned and held at the bank or transit and gold bullion held at the bank or held in another bank on an allocated basis to the extent the gold bullion assets are backed by gold bullion liabilities. So in other words, they're equating cash to gold. Okay, this I believe is where Andrew Maguire said cash is basically a tier 1 asset, because at the top of the risk factor, or with no risk, is cash at 0%. You can see down here at the very bottom of this chart, cash is at 0% right here, meaning it has no risk. It gets no risk factor. It doesn't get discounted in the net stable funding ratios. And gold in 2017, the BIS gave countries and their regulations and banks as regulated by those countries the ability to equate gold with cash, meaning gold, as long as it's held in allocated form, it's owned by one owner, it's documented, they know where it is, they can get to it and redeem that gold, is equivalent to cash. So it's basically the highest tier of asset in the banking system equivalent to cash. You call it tier 1, you call it top tier, you can call it whatever you want. It's basically equivalent to cash, and based upon this 2017 paper. There's a difference, however, between allocated gold and unallocated gold. So the 15% haircut still applies to unallocated gold. What is unallocated gold? Well, an example of unallocated gold, as I've talked about in 4 videos earlier this year, has to do with the LBMA gold market, because it's an over-the-counter privately traded market. It's unallocated gold, meaning you can get exposure to gold through paper derivatives, but not necessarily be able to take delivery of that gold immediately. You may just have exposure for purposes of offsetting your risk somewhere else in the gold market, or in some other market where you're using gold as potentially a hedge, a derivative hedge, but a hedge, or you may be able to get access to physical gold in that market, but all of those unallocated derivative positions are not backed by by 1 ounce of gold in the LBMA, therefore it's unallocated. So the question is, why is the LBMA so worried about its unallocated gold market? Because their gold is not allocated. It's not 1-for-1 to the trades. It's not locked in a bank where you can get access to it and there's only one claim on that gold, and that's the gold holder. Therefore, the European Banking Authority's opinion was to treat this market, this unallocated gold market, as higher risk than allocated gold held by banks in their name, directly in their name, that they held in their name only. And so per the LBMA website, they basically, the European Banking Authority said, well, when we consider your gold London market, we're going to consider it unallocated. So we're going to give it this 15% risk haircut. So that explains why there's multiple measures for gold, depending on what type of gold. Unallocated gold still gets the 15% discount in value treatment, whereas allocated gold is basically equivalent to cash. Okay, so hopefully it clears that up. Let's go further. There's another liquidity ratio that came about as a result in reforms of 2013 version of Basel III. And here's a quote from one of their papers. The LCR promotes the short-term resilience of a bank's liquidity risk profile. It does this by ensuring that a bank has an adequate stock of unencumbered, high-quality liquid assets. A new term here, high-quality liquid assets, that can be converted into cash easily and immediately in private markets to meet its liquidity needs for a 30-day calendar day liquidity stress scenario. It will improve the banking sector's ability to absorb shocks arising from financial and economic stress, whatever the source, thus reducing the risk of spillover from the financial sector to the real economy. So not only do we have a sort of longer term net stable funding ratio that has to do with asset quality to be used in the capital ratio calculation for Basel, we have this shorter term measure called the LCR that is basically a 30-day measure. And they want to know, how liquid can you be if you have a crisis? Can you liquefy some of your assets within 30 days? That's measured by the LCR. It's a different measure. It's a short-term, immediate stress, panic in the banking market. Can you liquidate your assets and basically get them to a cash position and stay solvent? That's what the LCR is measuring, as opposed to the net stable funding ratio, which is more of a long-term measure, overall asset quality to capital. So the LCR more specifically is a time-sensitive ratio. It describes a bank's immediate liquidity in times of stress. The criteria for determining LCR is that it's low risk, has an easy uncertainty evaluation, low correlation with risky assets, and it's listed on a recognized and developed exchange. These assets are considered high quality liquid assets if they meet level 1 and level 2 requirements. Now, this is where Andrew Maguire probably said tier 1 asset, because now we're saying that there's level 1. So for the first time, the BIS has started to define assets as level 1 or level 2. Now, not tier 1 or tier 2, but level 1 or level 2. And this took a long time to come about. This took years to come about. And as you see the progression of how the Basel has treated assets, you start to see better terms come out because they had really good terms for capital. Remember the top of this ratio at the very beginning. They had tier 1, tier 2, and tier 3. They didn't have the same thing for the assets on the denominator of the equation until they started getting into these additional ratios and they started talking about level 1, level 2, and level 3. So level 1 has cash, central bank reserves, and certain bank marketable securities. Level 2 of the LCR has government securities, corporate bonds and debt securities, residential mortgage securities, and certain types of equities. And there's actually 2 level 2s, there's A and B. So they're distinguishing between 2 different qualities of level 2 and then the quality of level 1. So now we're starting to get more specific as to the actual asset classes on the denominator of that equation. Now, it's interesting to note, gold is not called out here for this ratio. It is for net stable funding, the long-term aspect of a bank's balance sheet, but not the short-term 30-day liquid ratio. The BIS defines high-quality liquid assets as they're considered to be high-quality liquid assets if they can easily and immediately convert it into cash at little or no loss of value. The liquidity of an asset depends on the underlying stress scenario, the volume to be monetized, and the time frame considered. Nevertheless, there are certain assets that are more likely to generate funds without incurring large discounts in sales or repurchase agreement markets due to fire sales, even in times of stress. So what did we talk about with treasuries in the repo market lately? There was a shortage of treasuries, and that led to basically a run on liquidity in the repo market. So would treasuries be considered a high-quality liquid asset? I would argue the last part of this definition, without incurring large discounts in sale or repurchase agreement markets, means that treasuries may not be high-quality liquid asset, but a lot of these treasury securities are considered to be level 2 government securities. So I don't know if I would define them as part of high quality liquid assets due to the recent repo problems, but the Bank of International Settlements is. So for purpose of that definition, treasuries are considered high quality liquid assets. Again, gold is not in here, but I'm going to show you research where researchers have said gold meets all the requirements of HQLA, and the BIS should reconsider their position with respect to terms of this short-term liquidity ratio measure, the LCR. So there's a research paper. I will link to it at the very last slide of this presentation, which you can read, but I wanted to pull out one chart. Gold is not currently included as an HQLA, but here's a research showing that it has very little relation to speculative markets. Therefore, it is a good hedge against issues brought about by rampant speculation. Therefore, it should be included as an HQLA. It also meets the other characteristics. If we remember what the characteristics are, gold's low risk. It has an ease and certainty of valuation. We have the pricing scheme. We know what it's valued at any single point in time. The market data is out there. It has low correlation with risky assets, which I showed you in this chart. And it's listed on a recognized exchange. Of course, you have exchange in major countries for gold. You have the Shanghai, the TOCOM, the LBMA, the COMEX, and others. So gold does actually meet the LCR criteria, according to these researchers. It's just not been considered by the BIS in the definition of HQLA for purposes only of the LCR, not for the net stable funding ratio, but the LCR. So essentially, here are the conclusions we can draw from all of this research. Gold is considered at the top of the tiering system for stable assets. Now, I have a problem with the BIS because their tiering system with respect to assets is not as clear as it is with respect to capital. So that's probably led to people naming it tier 1, top tier, whatever you want to name it. It's just words. It's just semantics. It doesn't matter. Gold's at the top, and that's what matters. It's equivalent to cash where it sits in allocated form. Where it sits in unallocated form, such as the London market LBMA, it gets a haircut. It gets a reduction because there's risk there. So they reduce the value of it to deal with the risk because it's unallocated. You have more paper claims than you have actual gold. We're going to, reduce that. Initially, the BIS wanted to discount gold 15%, but they only do that now for unallocated. As I just said, allocated doesn't get a reduction. You can basically, it's equivalent to cash. It's very liquid. It's equivalent to cash in terms of stability. Essentially, countries are allowed in their regulations to consider gold as a top tier asset, although they don't refer to it specifically as a tier 1 asset. That's basically what it is. You can give it whatever name you want. The BIS tosses about HQLA, high quality liquid asset, but only in part of their documentation. Elsewhere in their documentation, they don't define asset tiers. So if Andrew McGuire wants to call it a tier 1 asset, I've got no problem with it. Might as well. The BIS is pretty lazy there in defining that. So we might as well come up with our own term. Whatever you want to call it, gold's equivalent to cash where it's held in allocated form. That's what matters. And as for the 30-day liquidity measure, gold has a ways to go to get recognized by the BIS, but the researchers have shown it meets the requirements by the BIS, published papers to that extent, and therefore gold should be considered for short-term bank asset stability measures. Is it considered overall in the capital ratio? Yes, just not the short-term measure, but researchers have said it fits perfectly in the short-term measure. In fact, gold outperforms when you're having bank stress, and if anything, it should be one of the most considered assets in a short-term stress scenario. And that's the last place that gold needs to be inserted in the BIS regulations, is in the short-term ratio. But essentially, gold is equivalent to cash for long-term bank holdings. It makes it a top-tier asset, regardless of how you want to name that tier, and that's what matters. So at the end of the day, gold is as good as cash in the banking system when it's held in allocated form. And those are the facts that we have for you from the BIS. Here are all the references we have links to: international convergence of capital measurement and capital standards, part 2, the first pillar, minimum capital requirements, the liquidity coverage ratio, the suitability of gold as an HQLA, Basel III, the net stable funding ratio, and the net stable funding ratio update from the LBMA. All of these links basically prove out what I just said, and that is documentation that, yes, indeed, ladies and gentlemen, gold is considered as a top tier asset in the banking system with respect to net stable funding ratio and the funding requirements that they need to meet capital ratio requirements. The only difference is in that 30-day sort of stress test measurement, the LCR, gold hasn't been considered a high quality liquid asset, even though researchers have proved through data that it should be, because it's actually better than things like bonds and other things, and it should be in there. That's the one area where the BIS probably needs to improve in putting gold into their equations. But essentially, allocated gold and gold held in allocated form is as good as cash on a banking balance sheet, and that's what matters. Whether or not they call it tier 1 or tier 2, I don't really care. I think it's nitpicking for Moneko to come and call out Andrew Maguire calling it a tier 1 asset and then go email the BIS and have the BIS respond that way. It's all word semantics and wordplay. At the end of the day, I've shown you where the BIS has said gold is as good as cash when held in allocated form. That's what matters, regardless of what they call it. And if we should be calling anyone out, it's the BIS for their lazy naming conventions when it comes to assets, because they've defined tier 1, tier 2, and tier 3 capital, but they've only defined assets into tiers very informally and very confusingly, and you really have to dig in their documentation to understand it, which is why there's so much confusion. And I understand why there's confusion, but hopefully this presentation has cleared it up for you. The last point I want to make is the thing that really matters. What are central banks doing with gold? Do they consider it a valuable asset? So we're going to go back to the share here, and I'm going to show you where they consider it a valuable asset, because we have 2 charts for you on central bank gold holdings. The first one is from Bloomberg from late in 2020. Central bank gold buying seen climbing from near a decade low. So here is the actual increases in central bank purchases since 2010 of gold. You can see when we had the crisis, they started increasing their holdings of gold. They really ramped it up in 2018 and 2019 to highs for the last 10 years. Bloomberg here was predicting that the end of 2020 and 2021, they would continue to have a lot of purchases of gold, although I think related to the pandemic, some of the gold purchases slowed down. So we have another chart here for 2020. This one is from Gold Hub blog. Central banks resumed net gold purchases in October, but they fell. There was a net fall actually in September, but they started to regain at the end of the year. So there was a period of time right in here where the net, these 2 months basically, or these 3 months, where the gold sales were higher for the central bank than the purchases, but overall for the year, they were higher, meaning central banks have consistently purchased more gold than they've sold. And this has been dating back 10 years, dating back to the last crisis. So essentially, since the last crisis, central banks have bought gold hand over fist. There have been periods of time where it's a little bit less or a little bit more, but essentially that trend has continued, and they're doing it to capitalize their balance sheets. Why? Because gold is considered as good as cash for Basel regulations as long as it's allocated. And of course, the central banks hold this in allocated form in their vaults. That's why Gold is considered basically a good quality asset, top tier asset, tier one, whatever you want to call it, doesn't matter. And the central banks are the proof in the pudding because they're the guys that issue the currencies. So we're talking about supporting entire economic systems of the economy worldwide. If the central banks are doing it, then that's an indication they value gold. They've been buying it hand over fist. And according to the BIS, as long as it's in allocated form, it's equal to cash. That is a fact based upon information we brought you from the BIS. So again, going back to that initial video from Ineko, he showed an email saying that gold is not tier one asset because there's no such thing as tier one asset. There's only tier one capital, okay? Remember, that's equity and retained earnings. The assets are on the bottom side of the equation. The BIS doesn't define them very well. They use different terms in different places. It's lazy naming convention, but essentially gold is equivalent to cash at the top of that tiering system. So we can call it tier one if we want. We can call it top tier. We can call it good as gold or good as cash if you want. Either way, gold retains its place at the top of the asset system in the banking system. And the proof is in the pudding, as I just showed you. The central banks at the top of that banking system are the ones buying gold hand over fist. I think that answers the question pretty definitively. Hopefully by the time this video comes out on my channel, Mario has updated his. He said he would do that over Twitter. Hopefully we can put all this behind us in the gold community and stop having all the arguing back and forth as to what gold's role is going to be in the banking system. Pretty darn clear what gold's role is going to be. I think they're going to use it to recapitalize their system when gold revalues and they go into their digital currency phase and the paper currencies start to suffer and they make that transition. I've said that and it's a prediction on my website. You can go see that at goldsilverpros.com as well. If you want to go to goldsilverpros.com, let me see if I can show the website here real quickly. If you want to go to goldsilverpros.com, essentially, we have two registration options for you. You can go to the newsletter section, and this is free registration. This is where you get updates when I release a video or release other free content. This is free, no obligation. If you want more information on joining as a paid subscriber, you get access to our quarterly newsletter, our Gold Silver Pros University, where we teach you about a lot of this stuff that we've been talking about, teach you the basics of economics. And you want special releases, you can become a subscriber by clicking on that button there as well. Guys, that's going to do it for today. Thank you so much for following me, and thank you for allowing me into your living rooms. And thank you for being patient as we explain gold's role in the new financial system according to Basel regulations and why gold is as good as cash and why Andrew Maguire is essentially right. Thank you for allowing us to walk that through with you today. If you got questions, leave them down in the description. I'll answer them to the best of my ability. Until next time, this is Rob Keynes with goldsilverpros.com.